Grab, the leading super app in Southeast Asia, has gained a lot of buzz lately during the 3 day weekend celebrating President's Day. A chain reaction of events gained the attention of many investors. First, rumors of a possible Grab Goto combination resurfaced once again, creating a flood of news headline about Grab. Second, several fintwit influencers began posting about Grab, which got the stock appearing in pretty much everyone's feed. And third, with Grab scheduled to announce its Q4 earnings results on February 19, many investors wondered if they should buy the stock in anticipation for a nice earnings pop. As a result, Grab stock rallied more than 10%, and all of a sudden, Grab became everyone's favorite stock. However, the rally was short lived as Grab reported mixed Q4 earnings results, sending the stock 10% lower the following day. So, in today's video, I want to talk about Grab's Q4 results, what went wrong, and whether Grab stock can 10x like many people claim over the last few weeks. As always, you can read the article version of this analysis, which I will leave the link in the description box below. And with that being said, let's not waste any more time and talk about Grab stock. All right, looking at Grab's growth metrics, monthly transacting users or MTUs was 43.9 million as of Q4, which is up 16% year over year, adding 2 million users quarter over quarter. I've always said that MTU, or the number of users, is the most important metric to track for Grab, as it is a leading indicator of future revenue growth and subsequently earnings growth. So to see Grab grow its MTU and to see the Grab ecosystem continue to expand to record numbers as of Q4, as you can see, it is very encouraging to see, and this should support robust growth for many years to come. Also worth noting, users who subscribe to Grab Unlimited, which is a paid subscription plan that offers users additional benefits and discounts, reached an all-time high in Q4. So Grab Unlimited users are some of the most loyal and engaged users on the platform, and they will help Grab generate higher quality, more stable revenue growth in the future. So that's really good to see. That being said, as a result of strong MTU growth, on-demand GMV reached an all-time high of $5 billion dollars in Q4, which is up 20% year over year, with growth accelerating 5 percentage points quarter over quarter. Breaking it down by segment, deliveries GMV was $3.2 billion, dollars, up 19% year over year, with growth accelerating 7 percentage points quarter over quarter, driven primarily by a 17% increase in deliveries MTU, as well as higher spend and order frequency levels. Notably, Grab's laddered pricing strategy is becoming a sustainable engine of growth as Saver Deliveries, which is Grab's budget delivery option, now accounts for a third of deliveries transactions, growing from 23% last year. And keep in mind that Saver users transact 1.7 times more than non-Saver users, helping drive higher order volumes. At the other end of the spectrum, priority deliveries, which offers users a shorter wait time in exchange for higher delivery fees, grew to 9% of deliveries transactions, up from 6% a year ago. And keep in mind that priority deliveries drove revenue margins that were 1.7 times higher than standard deliveries. So the continued growth of priority deliveries should help drive higher profitability over time. GrabMart also gained a lot of traction, growing faster than the delivery segment as a whole. So, according to management, users who use both GrabMart and GrabFood recorded 2.2 times higher frequency levels and almost 2 times higher retention rates. In other words, users who use multiple Grab products are more engaged and more loyal, and considering that GrabMart comprises less than 10% of overall deliveries GMV, I think there's substantial cross-selling opportunities ahead for Grab. Turning to the mobility segment, mobility GMV was $1.8 billion dollars in Q4, up 23% year over year, with growth accelerating 3 percentage points quarter over quarter. And this strong growth was driven by a 22% increase in mobility MTUs and a 5% increase in average order frequency. And similar to the delivery segment, Grab's laddered pricing strategy also has a positive impact on the company's mobility segment. For instance, saver rides now makes up 26% of mobility rides, up from 23% a year ago, which drove higher order volumes as saver users transact 1.5 times higher than non-saver users. High value rides, which charges customers higher fees in exchange for improved convenience, reliability, and comfort, grew 23% year over year. And this is an important development as high value rides generate 2.5 times higher GMV per ride and 3.4 times higher driver earnings per ride as compared to standard mobility rides. So, all in all, it's really good to see strong growth across Grab's on demand segments. However, the downside is that Grab is paying a lot more incentives to drive this growth. As you can see, the growth rate in total incentives have accelerated for 7 consecutive quarters. So as of Q4, total incentives was $512 million, dollars, up 29% year over year, which is 9 percentage points higher than GMV growth of 20%. As a percentage of GMV, total incentives was 10.2% in Q4, which is up 70 basis points year over year and 30 basis points quarter over quarter. Keep in mind that incentives has a negative impact on revenue, so if incentives grow too fast, revenue growth will be slower, which also negatively impacts earnings growth. While this may be concerning for investors, keep in mind that management is using incentives as a lever to maximize new product adoption and user growth, which I think will pay off in the long run. With that in mind, revenue for the quarter was $764 million in Q4, up 17% year over year, beating analyst estimates by $10 million. In addition, 2024 revenue was $2.8 billion, up 19% year over year, exceeding management's guidance of 2.76 billion to 2.78 billion. So looking at revenue by segment, deliveries revenue was $407 million, up 13% year over year, and this was driven by higher GMV and higher advertising revenue. According to management, advertising revenue is now at an annual run rate of $216 million, representing 1.7% of deliveries GMV, up from 1.4% a year ago. In Q4, self-serve active advertisers were up 63% year over year, while average spend per self-serve active advertiser increased 21% year over year. So with such strong momentum in the advertising business and with less than half of merchants using Grab's advertising services, I think there's a huge monetization runway ahead for the advertising unit. Moving on, mobility revenue was $282 million in Q4, up 19% year over year, and this was driven by GMV growth. And lastly, we have the financial services segment, which generated $74 million of revenue in Q4, up by 38% year over year. This was mainly due to the growth of the lending business, with loans disbursed up 44% year over year and its loan portfolio up 64% year over year in the quarter. Its digital banking business is also growing nicely, with customer deposits up 12% year over year to $1.2 billion, ending the quarter with approximately 4 million accounts. So the majority of these 4 million accounts were opened by existing Grab users. I think it was like 90%. And considering that 4 million accounts is less than 10% of its monthly transacting user base of 44 million as of Q4, I think there's substantial cross-selling opportunities in terms of getting existing Grab users to open an account in Grab branded digital banks. That being said, expect the financial services segment to continue its robust growth profile over the next few years. In terms of the outlook, management expects Grab to maintain its strong growth momentum in 2025, with 2025 revenue of 3.33 billion to 3.4 billion, which is up 19% to 22% year over year in a constant currency basis. This also means that growth is set to accelerate from Q4's growth of 17% and 2024's growth of 19%. So that's really good to hear. However, it's important to note that the midpoint of management's guidance miss analyst estimates of $3.4 billion, which is probably one reason why the stock sold off after its earnings release. That being said, I'm not too concerned with the slight miss. I think Grab will continue to outperform expectations as they always does. And besides, Grab still has so much growth runway ahead, especially considering that Grab is only serving 5% of the Southeast Asian population. Turning to Grab's profitability, operating profit for the quarter was $2 million, improving $48 million year over year. As you can see, Grab is displaying strong operating leverage as operating profit, both on an absolute and marginal basis, continue to improve with each passing quarter. More importantly, this is the first quarter ever where operating profit turned positive, making a new era for the company. So as Grab continues to scale further, I don't see why operating profit won't continue to improve from here. In terms of the bottom line, EPS or earnings per share was 1 cent, which is in line with analyst estimates. That said, the improvement in operating income was due to improved adjusted EBITDA across all segments. As you can see, deliveries adjusted EBITDA was $57 million in Q4, representing a margin as a percentage of GMV of 1.8%, which is stable quarter over quarter, but it is down 30 basis points year over year. So the decrease in margins year over year was due to higher investments in new product initiatives to drive strong demand growth and to serve more users. Despite the margin weakness in Q4, full year 2024 deliveries adjusted EBITDA margin improved 88 basis points year over year. In addition, management reiterated their long-term deliveries margin target of 4% plus. As for the mobility segment, adjusted EBITDA was $153 million, and as a percentage of GMV, it represents an 8.4% margin, which is down 40 basis points quarter over quarter and 30 basis points year over year. So this was mainly due to increased spending to scale product initiatives that drive user growth and expand its addressable market. For the full year, mobility adjusted EBITDA margin remained stable year over year. In addition, management is still very confident that they'll achieve their long-term mobility margin target of 9% plus. So that's good to hear. And last but not least, the financial services segment recorded an adjusted EBITDA loss of 27 million, representing a margin as a percentage of revenue of negative 36%, which improved 4 percentage points quarter over quarter and 55 percentage points year over year. That said, it's no surprise that the financial services segment is still unprofitable given that management is still investing heavily in the massive fintech opportunity in Southeast Asia. I believe this is the right strategy. I believe this is the right way to go. But as the segment continues to scale, I expect profitability to continue to improve, and over time, the segment should turn profitable, which management projects to happen in the second half of 2026. So adding all these together, we get a total segment adjusted EBITDA of $184 million, which is a record high, representing a margin as a percentage of GMV of 3.7%, which is down 1%, 10 basis points quarter over quarter, but it is up 50 basis points year over year. So if we subtract regional corporate costs, group adjusted EBITDA was a record $97 million in Q4, improving 178% year over year, representing an adjusted EBITDA margin as a percentage of revenue of 13%, which improved 8 percentage points year over year. So as you can see, adjusted EBITDA margin is in a nice upward trend, and this was driven by economies of scale as well as a 13% reduction in regional corporate costs. So in terms of the outlook, management guided for 2025 group adjusted EBITDA of 440 million to 470 million, which implies a growth rate of 41% to 50% year over year. So if we take revenue guidance of 3.33 billion to 3.4 billion, we get an adjusted EBITDA margin of about 13% to 14%, which is up 2 percentage points to 3 percentage points year over year. So expect profitability to continue to improve from here. On the other hand, management's adjusted EBITDA guidance actually missed analyst estimates of 489 million. So not only did Grab miss revenue guidance, they also missed their profit guidance, which are major reasons why the stock sold off following its earnings release. However, I do think that management is sandbagging their guidance. For instance, at the beginning of 2024, management issued full year 2024 adjusted EBITDA guidance of $200 million dollars at the high end, which they beat by a wide margin, ending the year with an adjusted EBITDA of 313 million in 2024. So again, I think management is just being conservative, and as we progress through 2025, I believe Grab will continue to beat and raise their guidance, and I think this should re-rate the stock higher from here. Nevertheless, Grab continues to execute on their profitability goals, gaining operating leverage with each passing quarter, and this should translate to robust earnings growth ahead as the company continues to scale further. That being said, Grab continues to generate strong cash flows. In Q4, adjusted free cash flow, which accounts for capital expenditures and excludes net working capital changes for Grab's lending and digital banking deposit activities, was $61 million dollars in Q4, up from just $1 million dollars a year ago. However, keep in mind that quarterly free cash flow can be very volatile, which is why I have calculated adjusted free cash flow on a trailing 12-month basis, as you can see right here. So TTM adjusted free cash flow was $136 million dollars in Q4, up by $370 million dollars year over year from negative $234 million dollars a year ago. So cash flows have significantly improved on a year over year basis. So the trailing 12-month adjusted free cash flow margin is now at 5%, which is a significant improvement over the past few quarters, as you can see right here, demonstrating very strong operating leverage. Management also mentioned that they expect 2025 adjusted free cash flow to grow year over year on an absolute dollar basis in tandem with further expansions in adjusted EBITDA. So expect more cash flows to come. So as a result of improved free cash flow, net cash liquidity as of Q4 was $5.7 billion, dollars, which improved by about $600 million dollars year over year, as you can see. And to put that into perspective on how large $5.7 billion dollars is, it is about 30% of its current market cap of about $20 billion, dollars, which is, I think, which is very, very large. So with this much cash in hand, management has pointed out that they intend to use this cash for organic growth, which involves Internet of Things investments, AI projects, and EV fleet expansion. In addition, they could use their cash in hand to acquire another company. One potential candidate could be Goto, which is the Indonesian holding company that owns Gojek and Tokopedia. As you may or may not know, rumors about a merger deal between Grab and Goto resurfaced about a few weeks ago, and while Goto has denied merger talks with Grab, I wouldn't completely write off the possibility of a Grab and Gojek deal. I think it's highly synergistic given that has pretty much the same business model as Grab. It has the deliveries business, it has a ride hailing platform, and it has also a digital wallet. So I think Gojek will be a great acquisition for Grab as it will strengthen Grab's competitive position in Indonesia, thus generating immense value for shareholders. Last but not least, Grab can also use its excess capital to buy back more shares. They are currently executing their $500 million buyback program, repurchasing $37 million worth of stock in Q4. Given that Grab stock is still 70% off its highs and 50% below its spec NAV value of $10 a share, I think accelerating its buyback program would be a great idea right now. That's because Grab is still attractively valued at current levels. As it stands, Grab trades at an EV to revenue multiple of 5.2 times, which is still a significant discount from its historical multiple of 10, 20, or 30x. And considering Grab's strong competitive moats, long growth potential, and improving fundamentals, I think a 5.2 times revenue multiple is a decent multiple to pay with decent upside potential for investors. As for me, I have a 12-month base case price target of $7.04 for Grab stock, which represents an upside potential of 44% based on the current price of $4.90. So here are the assumptions of my model. This includes deliveries GMV of $33 billion by 2034, which is a 10-year CAGR of about 11% at a 4.5% adjusted EBITDA margin as a percentage of GMV, which is in line with management's long-term target of 4% plus. I also expect mobility GMV of 24 billion by 2034, which is a 10-year CAGR of 14% at a 9.5% margin, which is in line with management's long-term target of 9% plus. And finally, I expect financial services revenue of $2.4 billion by 2034, which is a 10-year CAGR of 25%, and I expect the segment to boast a 35% adjusted EBITDA margin in the long term. So assuming all this, I expect 2034 cash flows of $2.8 billion, and based on a perpetual growth rate of 2.5% and a discount rate of 10%, I arrive at a base case price target of $7 a share for Grab stock. So this is just the base case, and as you can see, I have the bear and bull cases as well, which represents an upside of 17% for the bear case and 76% for the bull case. With that in mind, I think many investors are disappointed that I only have a price target of $7 a share for Grab stock. Given all this hype about the stock recently, I think many investors expect the stock to 10x over the next 1, 2, or 3 years. But I hate to be a party pooper, but this is not going to happen because Grab is not a meme stock. Instead, it's a high quality growth compounder that will likely outperform the markets over the next few years. Whatever it is, I think Grab is still undervalued with decent upside potential over the next few years or so. The fundamentals tell me that the company continues to execute, and over time, I expect the stock to trend up higher and higher as a result of these rising fundamentals. So if you are a longtime follower of my channel, you know that I was one of the biggest bulls, biggest Grab bulls back when it was trading at $3 a share, back when nobody talked about Grab stock. Well, today it seems that everyone knows and talk about the stock. It seems that it has become everyone's favorite stock. And while it is good that Grab stock is gaining more retail interest and coverage, I think investors need to curb their expectations. Investors need to realize that Grab is not a meme stock. It's not going to double or triple in the next 2 or 3 months. But what I do know is that Grab stock is well positioned to outperform the markets in the next few years or so. Why? Because Grab continues to expand its ecosystem, delivering solid MTU growth quarter over quarter. It is basically a virtual monopoly in Southeast Asia, but what's interesting is that only 5% of Southeast Asia is using Grab, which means the company has a very long growth runway ahead. What's more, multi-product adoption and fintech adoption is still very low, which offers substantial cross-selling and monetization opportunities for Grab over the next decade. In addition, Grab displays strong profitability momentum with positive cash flows and a large cash position that represents 30% of its current market cap of about $20 billion. And best of all, it is still undervalued with 40 to 50% upside potential over the next 12 months to about $7 a share. This is why I remain bullish on the company, and this is why I have Grab as a top 3 positions in my portfolio, not because it is everyone's favorite stock. So with that being said, thank you guys so much for watching this video. I hope you find value in this video, and if you do, please leave a like, comment, and subscribe to my channel for more investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys in the next video.